This video will help you understand if your catch-up contributions need to be made as Roth. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. At the end of 2022, the Secure Act 2.0 passed, which pushed out a whole host of changes. One of those changes mandated that starting in 2024, if you're 50 or older and you're making catch-up contributions to your retirement plan, if you're also considered a highly compensated employee, your catch-up contributions will need to be made as Roth contributions. Now, there was a recent IRS notice that came through pushing that guidance start date out to 2026. So we've got a little bit more time to figure it out, but in this video, we'll break down who this guidance applies to and then what you'll need to do ahead of time. So let's jump in. So first up, who does this video apply to? Well, there's two main classifications. Number one, people who are 50 or older, or soon will be, and want to make catch-up contributions to their retirement plan. And number two, if you're considered a highly compensated employee according to the IRS. So let's touch on the first qualification. When you turn 50 or older, the IRS permits you to make catch-up contributions to your retirement plans. And this isn't just limited to 401ks and 403bs. You're also permitted to make catch-up contributions to some 457b plans, as well as simple IRAs and regular IRAs, to include Roth IRAs. And generally the thought process behind this is you're catching up for maybe some missed savings opportunities when you're younger, and maybe you're making more income today and you can afford to save more in the latter working years before retirement. For 2024, as it applies to 401ks, 403bs, etc., the maximum IRS contribution to those in 2024 is $23,000. And if you're 50 or older, your catch-up contribution is $7,500. Now, the catch-up contribution didn't change since last year, but in total, the contribution did change. So if you're 50 and older, the IRS permits you to make $30,500 a year in contributions to your employer-sponsored retirement plan. Now, this doesn't apply to after-tax 401k dollars. That's a different calculation. But as far as making any sort of like pre-tax or salary deferral contributions to your retirement plan, you're allowed to take a tax deduction of up to $30,500. There's also catch-up contributions permitted in simple IRAs or regular IRAs and Roth IRAs. Those are to a much smaller degree though. The good news is this IRS mandate, as far as mandating those catch-up contributions to be Roth, do not apply to simple IRAs, regular IRAs, nor do they apply to SEP IRAs. And for just a quick refresher, those don't even have catch-up contributions anyways because it's based on a percentage of compensation. So whether you're 60 or 20 and you're funding a regular or a Roth SEP IRA, you're allowed to just continue making full contributions to that. Now, originally, the IRS didn't care if your catch-up contributions were made as pre-tax or Roth, but now they do care. My hunch is because they're forecasting, hey, if you're financially able to make catch-up contributions, we'd rather collect some of that tax revenue today, so we're going to force you to make Roth contributions. And as a refresher, Roth contributions require you to pay income taxes on that money today. You then can make contributions to a Roth account, and that money grows tax-free forever, and you can pull the money out tax-free in retirement. But since it accelerates when the IRS gets their money, my hunch is that's what the government's trying to implement. Now, originally, the Secure Act 2.0 said that this mandate for Rothification starts in 2024. There was a recent IRS notice 2023-62 that pushed this guidance out to start in 2026. So we've got a little bit more time. And the mandate says if you're making catch-up contributions and you're considered a highly compensated employee, then you must make Roth catch-up contributions. So now let's define highly compensated employee, which is the other qualification we have to satisfy. So the Secure Act 2.0 defines highly compensated employee as anybody with wages over $145,000 in the preceding year. Now, wages are defined in the Act in Section 3121, subsection A, but to keep it simple, wages would be any form of like W-2 compensation. Now, specifically with wages defined in the Act says that these wages of 145 grand plus need to be from the current employer-sponsored plan's employer, so your current company, in the preceding year. And we'll touch on why that's a nuanced definition in just a little bit. But for the most part, if you were paid over 145 grand last year, you're probably going to be considered a highly compensated employee. Now, wages only apply to employed individuals at an employer. And that might seem intuitive, but I want to make a distinction between those who are employed versus those who are self-employed. If you're employed, pretty much all your compensation is wages, so that's cut and dry. If it's over 145 grand last year, you're probably going to be a highly compensated employee. However, if you're self-employed, you're a sole proprietor, maybe you run an LLC or a partnership, and as long as you don't file as an S-corp, then all of your compensation is not considered wages. So theoretically, if your LLC, again, not an S-corp, pays you $1 million a year, you're not considered a highly compensated employee because you're not an employee. Therefore, you can't be a highly compensated employee. However, if you do file as an S Corp, as you might know, a portion of the business revenue goes towards wages, probably to the owner, and a portion will just be considered net profits. The wages portion would be subject to this definition. So even if you're a single member S Corp and your wages exceed 145 grand, then now you are going to be considered a highly compensated employee. But as long as you're not an S Corp, theoretically, if you have a solo 401k, you can still fund your entire contribution as pre-tax regular salary deferrals and catch-up contributions as pre-tax. Jeffrey Levine over at the KitSys blog has a great article on this, and I'll link that down below. His thoughts on the justification behind why employed individuals versus self-employed individuals can have this flexibility is because if you're not a self-employed individual, you roughly know what your compensation is going to be throughout the year, pretty much starting on January 1. Whereas if you're self-employed, theoretically, you have no idea. Could be $1, could be $1 million. Now, will that flexibility continue forever? Probably not, but until then, these are the rules. So let's touch on a little bit of nuance as it pertains to the 50-plus-year-olds making catch-up contributions for highly compensated employees. Now, there's not much nuance to whether or not you're going to turn 50 in the calendar year, assuming you use the Gregorian calendar. But what about if you turn 50, you want to make catch-up contributions, but you're going to be a highly compensated employee, meaning you need to now make those as Roth catch-up contributions. What if your employer does not have a Roth option? Well, that's actually a really big problem. If your company does not offer a Roth option for making these contributions, yet the IRS is saying you're 50 plus making catch-up contributions and you're a highly compensated employee according to their definition, then you are not permitted to make any catch-up contributions to your retirement plan. Basically, if you can't do a Roth contribution, you can't do a catch-up. Now let's touch on the nuance that pertains to defining a highly compensated employee using that $145,000 number. So number one, that $145,000 number is supposed to increase with inflation over time. So as we look ahead to 2026, when this mandate goes into effect, unless they delay it further, we'll be looking at your 2025 wages to determine if you are a highly compensated employee. So the second nuance as it pertains to wages is the verbiage is very wonky, so stick with me. The Secure Act basically says if your preceding year wages from the employer that you're trying to make catch-up contributions to exceeded 145 grand, then you are a highly compensated employee. Now you might be thinking, what if I just changed employers? Well, hypothetically, this definition would permit someone who's on track to make $1 billion, who just recently changed employers, to both make pre-tax contributions to their 401k and make pre-tax catch-up contributions. And that's because their previous year compensation from the current employer was nothing because they just changed jobs. So theoretically, if my going rate salary out there is 200 grand a year, but I change jobs every year in the middle of the year, then my only preceding year compensation was theoretically $100,000. Which means that I am not going to be considered a highly compensated employee from my current employer because the preceding year compensation they paid me was less than 145 grand. So theoretically, if you change employers every December, regardless of your compensation, you'll always be permitted to make catch-up contributions as pre-tax contributions. And this isn't just some made-up TikTok financial advice. This is explicitly laid out in page 8 of the IRS notice, which I'll link down below. My thinking behind the reasoning for this is your employer probably shouldn't know what your previous year compensations were if they were from different employers. So to lower the burden on your current employer from requesting tax returns and, violating all the privacy rules that go into that, the Secure Act 2.0 probably just said, hey, if you're the current employer, you know what you paid your employees last year. And if you paid them more than 145 grand last year, then they're going to be considered a highly compensated employee for the purposes of this year's catch-up contributions. So as we wrap up, please keep in mind that this Roth mandate doesn't actually go into effect until 2026, even though the original Secure Act 2.0 said it would in 2024. But from a calls to action standpoint, the first one I would say is if you are on track to be 50 years old by 2026 and you want to make catch-up contributions, please make sure that you have the ability to fund your account as a Roth contribution. If you speak with HR or the investment custodian that runs the plan and you find out you actually can't make Roth contributions, that's a big problem. And so you're going to want to speak with HR ASAP and get the third-party administrator rolling on updating a summary plan description. If you currently file as an S Corp, and for current clients, we've already done this for you, but if you currently file as an S Corp, please make sure that your solo 401k, if you've established one, has been updated to permit Roth contributions. If you're self-employed in other ways, then you really don't have to worry about this. But if you're an S Corp and your wages probably will be exceeding 145 grand, then you're going to want to make sure you have the ability to fund your account as Roth. The second call to action, other than making sure your employer plan permits Roth, is to do some upfront tax planning. So for example, if you're 50 plus now and you're making catch-up contributions as pre-tax, you're used to getting a little bit more in tax deductions than you will get starting in 2026. Not only will your wages increase a little bit, so probably your taxes will go up, but also in 2026, we've got two things. One, this Roth mandate will kick in, and then two, barring any changes from the Biden administration, we will revert to the federal income tax brackets that were in force before the Trump administration implemented the Tax Cuts and Jobs Act. So for most people, that means your federal income tax bracket is going up. So not only will your federal income taxes be going up, but you're going to be taking less in tax deductions because you can no longer take a tax deduction on your catch-up contributions. So hopefully that was helpful. If you have further questions, drop them in the comments below. Get in touch on the website. We'll get you squared away. Until then, have a great rest of the week, and we'll talk to you later. Bye.